All right, let's talk about Net Pacific. Their latest financial report just dropped, and wow, the headline is that their losses have more than doubled. So, what's going on? We're going to dive deep into the reasons behind this pretty significant downturn and then unpack their game plan to turn things around.
The crazy thing about all this, it wasn't a surprise at all. Nope. The company actually warned everyone this was coming. This one sentence right here, from their guidance back in November 2025, was basically a giant flare signal of trouble ahead. It left everyone asking one big question: what is actually happening behind the curtain?
Okay, so here's how we're going to break it all down. First, we'll look at that initial warning they put out. Then, we'll get into the nitty-gritty of their three main businesses to figure out where the losses are really coming from. After that, we'll look at the hard numbers to see the full impact. And to wrap it all up, we'll check out their strategy for navigating this, well, pretty challenging time.
All right, let's kick things off with that warning. Before Net Pacific even released their official numbers, they put out what's called an earnings guidance. This is pretty standard stuff for public companies. It's their way of managing expectations, so investors don't have a heart attack on reporting day.
And the message they sent out was crystal clear. They basically said, hey everyone, just so you know, our first quarter losses for 2026 are going to be way worse than last year. This wasn't just some small dip, right? This signaled some serious financial pressure, and it really gets you wondering, what are the root causes here?
So to really get to that why, we've got to stop looking at Net Pacific as just one big company. Think of it as three separate businesses, all under one roof. You've got golf, you've got luggage, and you've got their financing arm. Each one has its own story, its own set of challenges. So let's unpack them, one by one.
First up, let's talk about their golf business. What they do here is sell these really high-end golf simulators, and they also run indoor golf spots, mostly in China. Now, you'd think tapping into a luxury market would be great, but right now they're facing some pretty big headwinds.
Yeah, this part of the business is caught in a bit of a perfect storm. For starters, consumer spending in China is slowing down, and you can bet that expensive, non-essential stuff like golf simulators are the first things people cut back on. At the exact same time, they're getting squeezed by intense competition from cheaper options. And the result? It's pretty brutal. Revenue fell so much that their gross profit actually went negative. Think about that for a second. It means they're literally losing money on every sale they make, and that's before you even factor in all the other costs of running the business.
Okay, now let's pivot to their biggest business, at least in terms of revenue, the luggage business. This is a newer venture for them, making and selling hard case luggage. But here's where it gets weird. Sales are actually going up, but the losses from this division are getting worse. So how is that even possible?
So what's the deal with losing more money when you're selling more? Well, the company lays out a few reasons. First, their factory just hasn't hit that sweet spot of production volume yet, so their cost to make each suitcase is still pretty high. They're also dealing with project delays that are being caused by their clients, which gums up the works. On top of that, the type of luggage they sold this quarter just happened to have lower profit margins. And to top it all off, they've been hiring more people and spending more on operations, basically betting on future growth that hasn't kicked in yet. You put all that together, and it's a recipe for some serious financial strain.
And finally, let's look at their financing arm. This is kind of their original legacy business, providing things like working capital financing. Profits here have also taken a pretty big hit, but for a totally different and much more technical reason.
Okay, let's break this down into plain English. Last year, the financing business got lucky with a couple of one-time boosts. First, they had what's called a reversal of expected credit loss. All that means is they had a loan they thought might go bad, but then it turned out to be fine. So they got to add about 1.6 million Hong Kong dollars back to their income. Cha-ching. On top of that, the way currencies moved gave them another $1.1 million gain. The thing is, these were one-off events. They didn't happen again this year, which makes the year-over-year comparison look way worse than it actually is, even though the core business is chugging along just fine.
All right, so we've looked at each piece of the puzzle. Now it's time to put them all together and see how it all shakes out on the company's bottom line. This is where we see the big picture.
And man, this table really tells the whole story in just 3 lines. Look at the top line. Revenue is actually up by 5%. That's from the luggage business, right? But then your eyes go to the next line and, gross profit has just cratered, down a staggering 44%. That confirms what we were just talking about, that new revenue just isn't profitable. And of course, that flows right down to the bottom line, where the net loss has exploded by 130%. 130%.
Let's put some real dollars to that percentage to feel the impact. In this same quarter last year, the company's net loss was 2.7 million Hong Kong dollars.
So that was our starting point.
And this year, that loss has ballooned to $6.3 million. That's more than double. This one number just screams how severe the combined impact from their new golf and luggage ventures really is.
This chart right here shows you exactly where that $6.3 million hole came from. You see, the financing business is still in the green, kicking in about $0.8 million in profit. But that profit is just completely swallowed up by the losses from the new businesses. A $1.1 million loss from golf and a massive $4.4 million loss from luggage. It couldn't be clearer. The company's big strategy to diversify is, for now, the source of all its pain.
Okay, so after swimming through all that red ink, let's talk solutions. Because Net Pacific isn't just sitting around. They've identified the problems, and they've actually laid out a pretty detailed strategic plan to try and pull off a turnaround.
For their struggling golf business, the plan is a three-part pivot. First, they're ditching the exclusive supplier model. Instead of just selling one brand of simulator, they're going to become a dealer for multiple brands. That gives customers more choice and makes their own business less risky. Second, they're getting out of the price wars at the low end. They're going to target high-end commercial clients and wealthy customers who care more about quality than cost. And third, they're just going to tighten their belts and streamline their operating costs to get more efficient.
And the plan for the luggage business, the biggest source of their losses, is even more ambitious. Step 1 is a huge deal. They want to stop just being a manufacturer for other brands and actually develop their own brand to sell directly to you and me online. That could be a game changer for their profit margins. Step 2 is to tackle that efficiency problem head-on by optimizing their production. Step 3 is all about getting the word out with much more aggressive marketing at big industry shows. And finally, Step 4 is to stop being so reliant on the US market by expanding into new markets over in Asia and Europe.
So, to wrap it all up, Net Pacific took a big swing with these new ventures, and it's led to some major short-term losses. But they have a very clear, very ambitious plan to fix it. The big question now, the one everyone's watching, is this: can these strategic pivots actually navigate this tough economic storm and get the company back into the black? The answer is really going to come down to one thing: execution. Can they pull off this very complex turnaround? Well, that's what we'll be watching. Thanks for joining this deep dive.